Allied Insurance Company Limited Q3 and 9 months FY23 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Mr. Prateek Patil from Adfactors PR, Investor Relations team. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone. From the senior management, we have with us Dr. S. Prakash, Managing Director, Mr. Anand Roy, Managing Director, Mr. Nilesh Kamli, Chief Financial Officer, and Mr. Anish Srivastava, Chief Investment Officer. Before we begin the conference call, I would like to mention that some of the statements made during the course of today's call may be forward-looking in nature, including those related to the future financial and operating performances, benefits and synergies of the company's strategies, future opportunities and growth of the market of the company's services. Further, I would like to mention that some of the statements made in today's conference may involve risk and uncertainty. Thank you, and over to you, Mr. Roy.
Thank you, Prateek, and good evening to everyone, and thanks for joining the Star Health earnings call. My name is Anand Roy, Managing Director of the company. So I'll be taking you through the performance of the company for Q3 2023 and 9 months FY23. I'll give you a brief overview of the industry trends and developments that we have witnessed in the last few months as well, and walk you through the company's performance in terms of premium and distribution. My colleague Dr. Prakash will cover the financial performance and aspects related to the claims, including the steps that we are taking to manage them. In Q3 2023, the health insurance industry, including personal accident, has grown by 24.6%, driven by 32% growth in group health and 17% growth in retail health. Now we will talk about the growth and market share for Star Health. For 9 months 2023, our retail health growth is 19.4% versus the industry retail health growth of 14.9%. That is, we are able to grow at 1.3 times the industry's growth rate despite a very large base. In Q3 of 2023, our retail health segment grew by 17.9% versus industry retail health growth of 16.8%. Overall, GWP for Star Health grew by 15% in Q3 FY23 versus 11% in Q2 FY23 over the same period of last year. In Q3 FY23, Star Health registered 34% market share in retail health, which is 3x the second largest player in the industry. For 9 months 2023, our retail health market share is 33%, an increase of 120 bps over 9 months FY 2022. We continue to grow higher than the market growth rate and continue to increase our retail health market share. As far as accretion share is concerned, Star Health has registered 42% retail health accretion market share in 9 months FY23. Agency business continues to contribute around 82% of the overall business for our company. Our agency strength has increased to 6,09,695 with an addition of approximately 23,700 agents in Q3 FY23. We are on course to add 80,000 to 100,000 agents in the current financial year, which was our target. With improving agency productivity, we are confident of maintaining our market-leading position in this business. For 9 months 23, corporate agents, that is banks and other tie-ups, continues to remain strong, and our premium has grown by 49% from this particular channel. Some of the highlights in Q3 FY23 for us were as follows. We are focusing on premiumization of our policies. The average sum assured of new policies has increased by 13% on a year-on-year basis to 8.8 lakhs per policy. We have implemented a hike in our flagship product, which is called the Family Health Optima, to combat the structural rise in medical inflation post-COVID of approximately 25% premium increase effective from 1st February 23, that is tomorrow, on new policies, and 1st May 23 on our renewal book. We have renewed our partnership with one of our leading bank partners, Punjab National Bank, for a long-term period. And We have also tied up with a reputed foreign bank, and since the paperwork is in progress, I'm not able to give the name now, but we will be able to further strengthen the sales of our products through the bank assurance channels that we have tied up with. The premium from benefit products has grown by 70% in 9-month FY23 over corresponding period last year. The share of such products within overall GWP has increased by 79 bips to 2.3% in 9-month FY23 from 1.6% in 9-month FY22. Rural business for us has grown by 48% during quarter 3 of this financial year over quarter 3 of last financial year. The number of rural agents has also grown by 69% to 3,861 agents in this particular quarter. Some of the outcomes of our digital initiatives are: our app downloads have reached 1.85 million downloads. The Star Power customer-facing app is now available both on the Android and iOS platforms. And the digital sourcing of our business, which we define as the premium collected directly from our website, as well as through third-party web aggregators and online brokers, has grown by 27% YOY and now accounts to close to 10% of our overall GWP in 9-month FY23. Organic traffic to the website has grown by 44% in Q3 FY23 over the same period last year and 14% sequentially over Q2 FY23. I now request my colleague Dr. Prakash to take you through the claims and financial matters.
Thanks, Anand. Let me talk about claims initiatives and outcomes. We are working on a 4-pronged strategy to effectively manage claims. Number 1, prudent claim settlement based on rich medical wisdom and insurance expertise. Well-negotiated, volume-based pricing arrangement with network hospitals, which gives us operating leverage in terms of lower average claim size. Then technology-enabled fraud detection and mitigation. The 4th one is risk-based pricing through micro-segmentation of portfolio. So we can say today that 80% of the amount in this 9 months of FY23 are settled in claims through cashless. Cashless turnaround time came in around 90% within 2 hours. Auto adjudication of claims helps in drastically improving turnaround time and thereby customer satisfaction. 17% of our network hospitals are being onboarded under this initiative, and the number of such auto adjudicated claims settled has risen to 40,000 in quarter 3 FY23, a growth of 21% versus quarter 2 of FY23. We continue to improve on the claims-related milestones. Within overall cashless claims, the share of hospitals with pricing arrangements, for surgical packages, room rent, professional charges, all these things is around 76% versus 64% in financial year 22. As you will be aware, fraud control is one of the critical factors to address in a retail health insurance business. Our anti-fraud digital initiative has become operational this year and has started to produce savings in claims outgo. There is a 1.2% incremental benefit in terms of lower claims ratio in Q3 of FY23 compared to Q3 of FY22. This is in line with our expectation of more than 1% reduction in claims ratio mentioned in the previous results call. Coming to the financial performance, we are focused on sustainable and profitable growth and also taking our decision to achieve that goal. Combined ratio for the 9 months of FY23 has improved to 96.9% versus 125% in 9 months of FY22. Improvement in combined ratio is achieved through claims ratio improvement. Combined ratio in Q3 FY23 for the quarter was 94.8% versus 135.7% for the quarter Q3FY22. Claims ratio for 9 months of FY23 has improved to 66.1% versus 94% in the same period last year. 9 months 2023 claims ratio has 0.5% impact of COVID claims. The claims ratio in quarter 3 FY23 has improved to 63.7% versus 104.6% in quarter 3 of FY22, and this was 68.2% for quarter 2 FY23. As mentioned in the H1 FY23 results call, while Q3 is prone to epidemic-related claims generally, we did not see any major impact during this quarter. For the month of January also, the claims ratio is approximately around 62.3%, and the YTD claims ratio as on January end is approximately 65.7%. We reiterate our claims ratio guidance now that we are 10 months in the year. Expense ratio has fallen slightly in 9 months to 30.8% on account of efficient cost management, as evidenced by a reduction in expense ratio in Q3 FY23 to 31% from what was 31.2% in Q3 FY22. You will appreciate that the expense ratio has remained stable in spite of a significant cutback in the group business, which has a lower expense ratio. So the 9 months of FY23 recorded a profit before tax of rupees 690 crore and profit after tax of rupees 517 crore. Adjusted profit after tax, excluding non-business ESOP cost, is rupees 627 crore in 9 months of FY23. For quarter 3 2023, the profit before tax is 282 crore and profit after tax is rupees 210 crore. Our investment assets have grown to rupees 12,079 crore in the 9 months of 2023 versus rupees 10,441 crore in the same period last year. With stability in claims in the trailing 12 months, we have successfully transitioned to the premium basis of solvency during this quarter. Solvency as on 31st December 2022 is 2.17 times compared to regulatory requirement of 1.50 times. This solvency is achieved through only mandatory 4% reinsurance. To conclude, we continue to believe in the profitable growth opportunities available in retail health segment, and we are on desired path of realizing the same. Thank you.
So should we open the line for Q&A?
Yeah, we can open it up for Q&A.
Sure, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, good evening, everyone. Thanks for the opportunity. So, firstly, on the loss ratios, right? So, if you can just give out some numbers around what are our loss ratios in the FHO book, Star Comprehensive book, and Young Star book for 9 months in Q3, because it becomes very important to understand where this improvement in claims ratio is coming from, which product is actually driving the improvement, given that we have already taken a price hike of 25% in our flagship product, so the claims ratio were inferior. So if you can give us some sense around that. That's the first question.
See, this is what we always adapt a comprehensive approach in controlling claims, and we monitor every product and we see whether it remains within the threshold. And if it is close to or if it is crossing the threshold, then we go for a pricing revision. But product-wise may not be like, overall approaches on how we can effectively manage claims, look at a better pricing arrangement with hospitals, and also address on potential frauds. Detecting these frauds and mitigating the fraud is these are the priorities that we know we have adapted to achieve our ICR, as you could see.
No, sir. So, I mean, our loss ratios for Family Health Optima was at 93% for FY22. So, where are we on this book for 9 months FY23, given that this is the largest portion of our book? So, what is the claims ratio for Family Health Optima versus the 93% in FY22?
See, Sahej, the product level loss ratios are not in the public domain. That's a competitive information. The price hike is effective 1st February 2023, and we have given guidance that whenever a loss ratio reaches a certain threshold, we go in for the price increase. It's 65 to 70% that we have maintained that, once it starts touching that level, we go in for a price increase.
I was reading into the loss ratios from the public domain itself on what you have disclosed for FY22, which says that the loss ratios for FHO book was at 93%. And for Star Comprehensive at 64, for Star Comprehensive and Youngstar at 64-65% for FY22. So
yeah, so that's a full year disclosure that is mandated as per IRDA. So once the full year is over, we'll put that in public.
Right. So I mean, even if you don't want to give out those numbers, if you can give us some sense that the loss ratios for Star Comprehensive and Youngstar, if they were at 64% for FY22, so have the loss ratios in those buckets improved materially, or they are there itself, whereas FHO book has seen
FY22, when you look at the loss ratios, they had the impact of COVID. So it's difficult to compare FY22 vis-a-vis FY23 because there is a COVID impact in FY22.
But the improvement, is it fair to assume that the improvement has largely come on the back of FHO book?
It's an all-round improvement,
I do not know how you are trying to understand whether it is through FHO book, because FHO price hike is being contemplated and it is yet to be rolled out.
Right. Got it. Maybe I'll take this offline. So if you can just share out what's the share of FHO in our current book as of for 9 months?
46%. Around 46%.
Got it. 46%. Right. And so next was on growth, right? So given that for us, the growth in the retail business has moderated to about 18-19% for this year. How should we look at the growth for the retail business, given that we are still very aggressive on the agency channel? So for the next maybe 2-3 years, can that...
Hello.
Yes, Mr. Mittal. So please go ahead.
Maybe you can join the queue later.
So it seems there's no response from the line of Mr. Mittal. We'll move to the next question. That is from the line of Avinash from Emkay Global Financial Services. Please go ahead.
Yeah, hi. Good evening. First one on this repricing of price hike on this Family Health Optima for new and renewal. The question is that, what sort of a comfort do you have around retention in case of old book and in case of growth as far as the new business is concerned, because a 25% kind of a price hike, if I remember correctly, is reasonably, I would say, a material price hike for a health product, and particularly in a competitive environment. So how comfortable or confident are you on the retention as well as the growth with this kind of price hike?
Hi, Avinash. So we have, of course, evaluated all the various angles before we arrived at this price hike, both from the competition point of view as well as from our internal, strategy point of view. So, as you are maybe aware that the Family Health Optima has 4 zones in which it is divided. Though the overall price hike is 25%, the zone-wise price hike varies. So we have kind of, aligned the price hike to ensure that the retention book is not disturbed and total new business also can be assured. So we are very confident of, managing that.
And you have got this, regulator go ahead, or it will be like use and then file a way of repricing?
We have got all the go aheads, all the systems are ready. We are rolling out tomorrow morning.
Okay. And secondly, on the banker side, now of course you are adding incrementally, particularly on the public sector banks. Now, sort of of course, growth is strong. But what kind of eventually 2-3 years out, what kind of a share from that distribution mix you see in your overall business mix? I'm asking, I assume that you would be offering kind of a group of product, or like it is sold as individual product in bank branches?
So banker, our strategy is very, we have very aggressive plans to expand our book in the bank assurance space. We have shown, very good performance in the first 9 months, but we believe that, there's tremendous opportunity to grow further because of the regulations which has changed. Now banks are allowed to have tie-ups with 9 insurance companies each. So we are in talks with some of the potential partners. So as we speak, our contribution from bank assurance is, we have already done more than 10% in terms of our new business contribution. We want to take this up further, but this business is growing very fast for us. And as the business is both retail as well as benefit products which are attached as a part of mortgage loans and other loans given by the banks. So I think this is also a very profitable segment for us. We are focusing big time on this.
Okay. And the full year combined ratio for FY23, 95% is maintained.
Yeah, we have given a range of 93 to 95%. We stick to our guidance.
Okay, perfect. Thank you.
Thank you. The next question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Yeah, thank you for the opportunity and congrats on good set of numbers, sir. So, first question is on the URR reserving. So I just wanted to understand how to think about this number, because in Q2, I think we reserved almost like 244 crores worth, and this quarter where I think there would be a higher share of unearned premium, we are reserving around 76 crores. So I just wanted to understand, how to think about this number and what should we think about it for Q4?
Swarnabh, when it comes to URR, you don't have to take the quarterly number. It's trailing 12 months number that you have to take. You have to month-wise, you put the premium month-wise in a table, and you take a URR charge every month basis, because it's a 1/365 rule. So very difficult to put a number on an incremental basis. It follows the trailing 12 months premium. So Q4 there will be a charge in the P&L because Q4 is the biggest quarter. Even now, if we split the business between retail and group, because we have degrown in group, it looks to be that the earned premium is slightly higher than the net return premium. But if you split it between retail and group, retail the net return premium is higher than the net earned premium.
Okay, got it. And in terms of in terms of the guidance on growth, not for this year, for the next say couple of years, given that we are almost more than third of the industry, and this year I think we have so far kind of grown in and around the lower end of our guidance range. So how should we think about it going ahead? Should we think about like a 20% kind of a number for say FY24-25? What are your thoughts on that?
So see, the headline growth for this year may look little muted because of the strategic choices we made on group business. But our area of interest, which is the retail health insurance, we have outbeaten the market by substantial margins despite having a large base. So I think the growth has been as per our plans. But more importantly, we are focused on a sustainable and a profitable growth model rather than, just growth for the sake of growth. We have taken some calls even within the retail space in terms of acceptance of business, in terms of tightening our underwriting guidelines, so that we have a very long-term view of this business and ensure that the quality is also maintained rather than the quantity alone. So going forward for the next 2 to 3 years, we believe that we will grow much faster than the industry as far as retail is concerned. The industry is typically growing at 14-15%, so we should ideally grow at the similar rates at which we are looking at. And hopefully from next year, the group business growth also will kick in because of the 12 months of our plan is playing out this year. So overall basis, yes, I think we should be able to deliver around that number which you mentioned, around 20% growth is something that we look forward to.
Sure, sir. And just about an indication for Q4, if you could maybe give some color on what would be, the loss ratio which we have maybe, we are seeing in January, and given that, Q4 would be a higher scale quarter. So should we be seeing a significant better profitability outcome as compared to what we have seen in Q3?
Historically, Q4 is better in terms of loss ratio as well as combined ratio. So whatever guidance we have given for the full year, we'll achieve that guidance of 93 to 95% combined ratio.
Okay, sir. Got it. Thank you and all the best.
Thank you. The next question is from the line of Anshuman Deb from ICICI Securities. Please go ahead.
Yeah, good evening, sir, and thanks for the opportunity. So, the first question is our guidance, I'm just rechecking, it is anyways factoring the price hike that we are contemplating, right? So that is question number one. And the question number two is that in terms of new business growth, in terms of we have been able to increase the sum assured, but what is the outlook looking at, for example, in the new business growth in terms of new policies, or what is the outlook? Because that was, I think, little muted in 9 months. And my last question is on the life insurance kind of composite license, and what is our take on that, and if any possible incremental threat can come from LIC agents going to maybe selling LIC product going ahead instead of any other companies. That's a case in point of the threat from opening up this composite licensing. Yeah, there are 3 questions.
What was the first question?
I'll answer the first question. So, in terms of price hike, the price hike is effective Feb 2023 for the new policies. So the guidance in terms of loss ratio does not change because, the earned premium will come in the next year, and the current price hike will get applicable only for the new policies for the next 2 months, and after 3 months it gets applicable for the renewal business as well. Does that answer your question, Anshuman?
Yeah, got it. Yeah.
So see, as far as the new business growth is concerned on the retail side, the first quarter was a very negative growth for us as well as for the entire industry because of the huge base of last financial year, the same period, because of the Delta variant. The sales are very, very high. But we have seen very positive growth in quarter 2 and quarter 3. And as we end the year, but the lag effect of the first quarter still remains, as you rightly said. So it's kind of neutral growth right now. But as we end the year, we are confident that we will achieve, good positive numbers. And, traditionally our new business has been growing very positively, and we don't see any reason why that will not happen this year too. As far as your second question about life insurance companies coming into this domain, we have been reading about that, and we are still in the exposure draft stage. We will see how that pans out. But as far as our business model is concerned, see, Star Health is not a new startup. We are a 15-year-old market leader in this industry, and as much as other companies have affinity towards their agents, our agents have a strong affinity with Star Health. And many of the people who are working with us for a long time have a very strong, customer base and trailing commission with the company. So we do not see any major threat in terms of anyone taking away our channels and our distributors. What we believe is that, this may affect the smaller players, but being a very large player in this segment, we don't see any major challenge.
Understand, sir. And sir, there was also media news that we have applied for a life insurance license. Any kind of insights on that?
It's just an exposure draft, It will have to go through various stages before it goes through. So it's still some time away.
Understood, sir. Thanks a lot. I'll get back in the queue.
Thank you. The next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Yeah, hi. Thank you for the opportunity. Congratulations on a good set of numbers. I have 3 questions. First is on the Insurance Amendment Act. There are multiple unanswered questions in the draft, obviously, as you've mentioned. So I just wanted your insights into, in case there is any change in the way agent relationships are defined. Like right now, Sahis have an advantage of onboarding life insurance agents. What kind of targets would you keep for your agent addition? Will that get disrupted? What are your views on that? First is that. Second is on the benefit policies. If possible, can you share the kind of loss ratios that you see on this book, and how large do you plan to make this book? Like if it's around 2% of your portfolio right now, how large would it become over 2-3 years? What, if any, guidance you can give about that? Last is, if I calculate the retail premium of new business, removing the renewal part over 9 months, or 1H over 1H last year, seems like the new business premium has sort of slowed down. It's more or less flattish now, and more growth coming from the renewal part. So any insights you can give to us about what is happening with the new business part of the book? Thank you.
Yeah, so see, on the agent addition side, we will be adding close to 90 to 100,000 agents this year also, and we hope to continue doing that given the regulation as it stands today. But the draft regulations do not talk about taking away the benefits of SAHI. The draft regulations talk about allowing composite licenses to come into play. So we will see how that pans out. But just for your information, you might be aware that we also do have a very large proprietary agency force of about close to 100,000 agents who are licensed with Star Health Insurance exclusively from us. So that will continue to be our focus area also, and we'll continue to add agents in that category. As far as our benefit plans are concerned, right now, as you mentioned, it is 2%. It is still a very small base, but growing fast. And this will grow further because we have tremendous focus on our bank assurance and partnership models. And also within our own ecosystem, we want to distribute retail benefit plans. We have a wonderful critical illness product, which is very unique and very beneficial to the customer. So from 2%, our aspiration is to take it to around 10% levels in the next 2 to 3 years' time with our partnership as well as through our direct distribution. And new business, I've already mentioned. Our new business growth is positive for the last 2 quarters. In fact, quite handsomely positive. But the first quarter of this financial year was, negative growth for us as well as for the industry because of the large base effect of the previous financial year. And we hope to end this year in a very positive note, even on the new business.
Sure, sir. Thank you. That answers my question.
Thank you.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi everyone. Congratulations on a great set of numbers. Firstly, on the loss ratio, So you're saying that you're already at 62.4% for the month of Jan, and the price hike is not kicked in yet. So such as parameters, do you think that your loss ratios could actually go down below 60% as well after the price hike, because it contributes to 25% price hike on a share of 46% is a big number that will come through. So do you think that the loss ratios can go below 60% as well in time, in say possibly first quarter or second quarter of next year, wherein the full benefits will start pouring in of this price hike?
Prayesh, what happens is, the new business price hike will be effective 1st Feb and the renewal business will be effective 1st May. The earnings will happen over, 18 to 24 months. The price increase of the premium does not reflect in the earnings, which has a bigger impact on the loss ratio. Second is, as we keep on taking the price increase, there is inflation and the other products as well. So it's moving cycles. It will move in cycles.
So in a way, you're anticipating the claim ratios to the claims to move higher, and that's the reason you're taking these price hikes. Because at 62.4% with the current inflation at with 62.4% loss ratio, why would we need a price hike?
Price hike is not decided based on the overall loss ratio. We have our strategy to study behavior of the product-wise. We study the loss ratios of individual products and we take a call.
To add, Prayesh, 62.4 is only for the month of Jan. For quarter 3 it is 63.7. So there is seasonality and cyclicality also in the business. So a month ratio cannot be a guiding factor for loss ratio determination.
The 62.4% is more because of frequency rather than severity, right?
We cannot say that. We cannot say that it's severity does have a role, and frequency we don't see huge fluctuations in this 9 months of this financial year.
Now coming to another part wherein now that you'll be taking a 25% price hike, and I think in a way you've answered this question, but from a retention perspective, even in terms of your claim rejection has gone up, right? So while you are right in terms of rejection of fraudulent claims, but do you see this coming to be out as a bad word of mouth and would impact your retention ratios? And are you comfortable with the 94% level? How do you see this panning out going ahead?
Our decision to reject a claim has no correlation to the overall ratios that you are talking about. So it all depends on a claim-to-claim basis. Our prudency is in studying the admissibility of a claim, and our business model is more agency-driven. So we are looking at every claim based on so many factors and trying to see that if a claim is not admissible as per the policy terms, then it cannot be entertained. And there is no big change in the rejection numbers. If I look at the last 3 quarters, I don't see any big change in the rejection numbers.
Okay. Got that. And so from a growth perspective, you mentioned that the group business can see a recovery now that that the entire piece of business is gone, that you wanted to move out is now out of the base. So one, obviously, what kind of growth we should presume, say, FY23 base in the group health business for say next couple of years, and this would be driven by what kind of policy?
So see, as far as group business is concerned, we are looking at our strategy is to focus on the SME segment, which is the sweet spot that we prefer. Typically, companies with 500 lives or maximum 1,000 lives in their rolls. So that's a sweet spot for us, and we are looking at that segment. This is almost a quasi-retail model. Most of this business comes from our agency force, from some of the broking relationship and the bank assurance partnerships that we have. And while the group business, the negative effect of that will get completed by the end of this financial year, and next year we hope that we should be able to grow this business also in line with our retail business. So achieve an overall growth which we are aspiring for, which is around 20% odd.
Great. Thank you and all the best.
Thank you. The next question is from the line of Sanket Goda from Spark Capital. Please go ahead.
Yeah, thank you for the opportunity. I have a question with respect to the third quarter result on the reserve release. I mean, 100 crores of reserve release has played a meaningful role in improvement in the loss ratio from previous quarter. So just wanted to understand what is this release about, and how do we see, is it a sustainable number given we over-provided in the first quarter and we expect this release to play out even in fourth quarter? That's my first question.
Yeah. So Sanket, reserve, claim outstanding plus IBNR reserve is a function of the claims ratio. As the claims have reduced and we keep on paying the claims. So,
right.
So it's not that it's gone out of the books. The claim outstanding gets converted into claims paid. What remains is outstanding claims as on 31st December 23. So as the claim ratio has seen an improvement, there is a corresponding improvement in the claim outstanding. In terms of IBNR, we still continue to maintain similar levels of IBNR, which we had in 30th September as well. So there is no release in the IBNR at all.
Okay, so basically on the reported claims, your experience has been better than what you have provided for the outstanding claims, and that's why the reserve release has happened. That's the way I should understand?
No. See, claim outstanding as on 30th September is a function of the claims reporting that has happened for the month of September and earlier periods. Right. Those 30th September claims which are outstanding gets paid in October, November. And what remains as on 31st December is the claims which have got reported in December. So that's the kind of improvement that we have seen. As the claims start getting paid, the outstanding claims keeps on reducing, the new claims keeps on adding. And since there is an improvement in the loss ratio, the overall claim outstanding has reduced.
Okay, got it. And the second question was basically, if I see the number of claims settled at the network hospital, that number has meaningfully improved in 9 months number, which is at 76, compared to the 65% number which was there for 1H. So, do I need to attribute to that factor also, which has played a role in improvement in the loss ratio, and this 76% number is sustainable going ahead or not?
Certainly, it has a dual advantage. It helps us in improving the loss ratio, and also it gives a lot of immense satisfaction to our customers. So we are very keen to achieve customer satisfaction. So this actually gives us a dual advantage.
Yeah, but sir, the 76% is compared to sudden improvement from 65 is sustainable. So which means that predictably you are seeing more claims settling at your preferred hospital, and you get a claim size benefit or lower claim severity benefit, and therefore the loss ratio could be better going ahead.
Yeah, you are. I agree with your views. I think our efforts to have a constant engagement with service providers and hospitals has yielded in a very, very beneficial support from our service providers, and we are able to increase our cashless participation.
Got it, sir. And the last one, see, I mean, 25% price hike what you're taking on the family FHO, see, completely can't be claim inflation. That's the or the hospital inflation. So large part, some portion of that 25% should trickle down into improvement in the loss ratio in FY24 as the books get renewed. So if I want to break down, if you can give a waterfall, the 25% breakdown, how much is because of the hospital inflation, and how much will result into the improvement in the loss ratio? Because anecdotally we don't get a understanding from speaking to the hospital that there was a hospital inflation of 25% in the current year.
See, I think your understanding on the price revision. Your price revision is not done anticipating a medical inflation. A price revision is not done in anticipation, but it is based on experience.
Right.
So based on our product experience, we go in for a price revision to achieve sustainable ICR for each and every product.
And the price increase is taken considering that it will be sustained for 3 years. It's not every year that we take the price increase.
So that's the point, Nilesh, that immediate benefit, given you have taken a price hike from 3-year perspective, so that immediate benefit probably will be more in FY24 and it will trickle, it will taper down as we move into, say, 3rd year of the price hike.
Yeah, Sanket, this remains to be seen. We are going to update you and we appreciate your good wishes.
Okay. And last one, sir. So this is the last price hike, or we can expect. I think around 8% of the portfolio in second quarter got repriced. Today now it is 46. So we are seeing a 57% book getting repriced. So can we expect another round to happen in other products, or this is broadly what we are going to experience in large part for next 2 years?
That will again depend on the ICR of the particular product. We only say that we have a close analysis and watchful of every product, and when that ICR of a particular product crosses that threshold, we will look into it.
Okay, sir. Fair point. And lastly, data keeping question. If you can disclose loss ratios broken down into group health, retail health, and maybe personal accident cover?
That's an annual exercise which will happen on a quarterly or 9-month basis. That's not available in the public domain.
Okay, perfect. Yeah, that's it.
Thank you. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening. Just a few questions from my side. First, if you can give the trends in the retention ratio, renewal ratio on the Medi-Classic product, where you take a price hike somewhere around June, July. That was the first question. Second, we have asked many times in this call on the new business growth, and it seems that at least for the third quarter specifically, there has been a decline, at least based on my calculations. So just wanted to get some sense if there is something that I'm missing, or is there some trend particularly out there. Third, on the regulatory changes, in case you decide to venture into life insurance business or protection or some other product segments, would it be organic or inorganic in nature? And is there any capital raising plans out there in case you were to take that route? And lastly, on the agent productivity, it seems that on a YOY basis for 9 months and 3Q, your productivity levels have been broadly flattish, while the vintage of the agency base continues to increase. So just wanted to get some color on what is happening out there.
Medi-Classic retention. Yeah, okay. So first, let me come to the Medi-Classic retention. So after the price hike, what we have taken, we have not seen any major drop in the retention. In fact, the retention continues to be good, and we are very confident that the price hike is being well accepted by the market, and that's being reflecting in the initial results. So I think that's quite good. As far as our new business for the third quarter is concerned, we have a positive growth. We are not declaring those numbers, but we do have a significant positive growth in our new business for the third quarter. It's not negative, as mentioned by you. And the last point about agents' productivity, what was the question again? Can you please repeat?
Yeah, so on the agent productivity, it seems to be broadly flat for some time, while the vintage of the agent base is growing. So just wanted to get some color on that.
Agent productivity is a function of addition of new agents as well. We have been adding 80,000 to 1 lakh agents. So if you exclude those new agents that have got added, the productivity is improving. It's a function of new versus old agents.
Sure. And lastly, on the regulatory change part, whether you want to venture into the life in case the composite licenses are allowed, and will there be any capital deployment plans out there?
So see, a few years ago, we had a product called Star Combi, where we had a term life, health indemnity and personal accident built into one plan. And there was quite a decent acceptance of that product in the market, but we had a partnership with one of the life insurance companies at that point of time. If regulations do allow, we don't mind evaluating that business again, because I think there is a need for that product in the market. But we will see as it goes, and the capital requirement will not be a challenge for a company like Star, which is focused on sustainable, profitable growth. I don't think capital will be a challenge for us.
Sure, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, thanks for the follow-up. So, sir, I mean, given that we'll be taking a 25% price hike in the FHO plan, I mean, we are taking it because we have seen some bad claims experience in this product line. But, you know, just understanding it fundamentally, what makes us so confident that the new business growth in this product will not be affected despite a 25% price hike, given that our pricing in family floater plans is more or less comparable to peers?
So see, first of all, let me clarify that the product experience has not been bad. You are comparing last year's loss ratios, which was because of COVID, and that's not.
I was picking this from what I heard, that you take a price hike after, so on the basis of product level experiences or the claims ratio which you face, not on an aggregate level but on the product level.
Yes, you're right. So that's what we do. We take a price revision based on the product experience, and which we have done for this FHO product. So as far as new business is concerned, we have done detailed analysis of the markets, of our competitors' product pricing with the similar product offerings, and we are quite confident that we will be able to pass on this price increase in the market.
Right. I mean, a 25% price hike seemed a large one for someone, even an agent selling that policy in the market. For him, a 25% price hike seemed a big one. So
we are very cognizant of that. This 25%, what we are talking about is an aggregate. So it ranges. It ranges based on the geography and based on the age group. So there are it is not uniform for across the country.
Right. And one clarification on the retail growth aspiration. So for the next 2 years, what kind of growth in the new business, so for the retail new business, should we assume? Can we expect maybe?
See, our aspiration, I've told you that we want to grow at 20% plus on the retail side, at least for the near future. And if we assume renewal retention to where it is right now, we should have the balance coming from new business. I think new business should also ideally grow at the same levels. That's our expectation.
So of the 22%, given that a large portion would be coming from price hike, is it fair to assume that 4 to 5% of this would be coming out of new business sold?
No, definitely not. We would do much better than that. When I said that, I am not, we are hoping that our new business growth should be in mid-teens, if not better.
Got it. Thanks, and all the best.
Thank you. The next question is from the line of Manish Gupta from Solidarity. Please go ahead.
Sir, what I wanted to understand is if you have 1/3 of the market of retail health, by definition, would your loss ratios be higher than your peers because you are more mass market vis-a-vis them?
So it's a function of two things. One is the maturity of the portfolio and the market share. So considering the maturity of the portfolio, when you compare to peers like Sahib players, we are slightly ahead of them, higher than them in terms of the loss ratios. But based on our scale and type of operations, it is in line with our expectations, internal expectations. Combined ratio. And the important measure is the combined ratio, where we have been giving a guidance of 93 to 95%, and that is our target basically.
So am I given to understand that our strategy is to grow at a certain rate, let's say 18 to 20. I'm just picking the 20% number as you said, 18 to 20. So is the strategy that we will grow at 18 to 20 with 93 to 95 combined ratio? And if our peers have a lower combined ratio, that's fine. Our strategy is balancing this growth with this combined ratio. Am I right in understanding that?
Yeah, you are almost right. But one thing we want to supplement here is, it is not just a growth, it is a quality growth. So we don't look into only the quantity, we look into quality growth. So we are confident that this quality growth should bring us more and more sustainable profit.
So what is quality of growth, sir? Can you please elaborate?
A proper underwriting done. It is not undertaking, it is underwriting the risk, assessing the risk, and identifying a profit-making channel. So these are all some of the elements of profitable growth.
So profitable growth implies 93 to 95 combined ratio. Is that understanding right?
Yes. So if you look at the peers, none of the companies are operating at this kind of combined ratio levels that we're talking about.
I'm not sure that's correct, sir, because if you look at Care Health, then for H1 FY23, their combined ratio was 92%.
Care Health still follows the 50% accounting method, so it's not comparable to that extent.
But so if we were to compare your claims by NWP, will that be like to like comparison?
What we can do is, we can take it offline,
Okay. So I have another one or two questions, if I may. Your OPEX to GWP is 16%. So how much of that 16% would be fixed cost versus variable cost?
Around 50% is fixed and 50% is variable.
Okay. And my third and last question, sir, was that in this family, another participant had asked this question earlier in the call. I just want to reconfirm this, that the 25% price hike, has this been approved by the regulator, or is this we file and the regulator will take a look at it later on, or this has already been approved by the regulator?
Yeah, this has already been approved by the regulator. They have looked at the various parameters and have approved the product. So they provide the UIN for the product, unique identification number, which we have received.
Okay. And my last question, sir, was that when the regulator examines your business and say you've got a product where your loss ratios are much higher, they allow you a price increase, but does the regulator ask you to give a discount, or how does the regulator adjust for the price increase they're giving you on a loss-making product vis-a-vis a product where your loss ratios might be significantly lower? So would the regulator examine this thing by product or as a portfolio?
By product. They look into the frequency, the severity, the loss pattern of every product, and the rationale for which we are asking for a price hike. So the parameters are verified, the rationale is being checked, and the futures are also studied by the regulator to see that whether the product deserves to be priced.
Thank you, Mr. Gupta. I request you to return to the queue for any follow-ups. We'll take the next question that is from the line of Anand from White Oak. Please go ahead.
Thank you for the opportunity. A couple of questions. One is the payments that we make to hospitals in the network for any particular procedure, as compared to the PSU insurer, do we on the same foot? Do we have to pay higher or lower? Give us some color.
The payment to the hospital, it depends on so many factors. The location of the hospital, the geography, and the expertise, infrastructure, and bed strength of the hospital, and the type of disease.
Same procedure, if in the same geography, same procedure for the same person, as a private insurer, do we have to pay more than a PSU insurer because there are 4 of these PSU insurers who have higher bargaining power and maybe they might get lower rates. So I'm just trying to understand if bargaining power is higher than us.
See, there are a lot of things which you need to understand when someone utilizes a claim in a health insurance policy. It is cashless, made free at the point of delivery, without any extra cost. So that is more important than the pricing arrangement. But we, as a very the number one standalone health insurer today, we have a stronger pricing arrangement and a better relationship with the hospitals. And we are guaranteed that, to our customers, we not only pay the claim, we also validate the need for an admission, whether the necessary procedure is being done. We give a free electronic second opinion to our customers. So our customers have a lot of value advantage. We handhold them and we sort of promote wellness in them. We try and see that how best we can prevent readmission rate and recurrence in our customers. So we offer more than what, I don't want to be compared to others, but I can soundly say that we offer more than reimbursing a claim.
Sure. Sir, my intent and the purpose of understanding this was, I was wondering whether our claims ratio can still fall further if there is some unutilized bargaining power with the hospitals available to us.
It's a continuous process. We continue to negotiate our terms and conditions with the hospitals and take the benefit of pricing based on our scale of operations.
Sure. And sir, my second question was on claims by customer category. And have you done any internal analysis on whether people who had contacted COVID, are they seeing any higher claims on any medical procedures or any particular illness? Is there any data for you to consider patients who have COVID infection to be more, having higher claims than others?
COVID as a disease, there are a lot of studies to look at the post-COVID complications, be it lung-related or blood vessel vascular complications. And in our experience, we only see that admission due to respiratory infection, those seeking the help of a pulmonologist, those admission due to respiratory infections, we see a small increase post the COVID. But how many people are exposed to COVID in India, given that, they might have got exposed through infection or through immunization or through communal immunity. So there are multiple factors by which someone would have got exposed to the virus. But in our experience, we don't see any alarming post-COVID related admissions. But overall, there may be a small increase in the number of admissions related to respiratory problems.
Sure. Thank you, sir.
Thank you. The next question is from the line of Bhavin Pandey from Trust Futures Wealth. Please go ahead.
Yeah, thanks for the opportunity. Just a couple of short questions. First thing, I just missed out on claims ratio guidance in the introductory remark. And secondly, what sort of distribution mix are we looking at over a 5-year period? As today, not of 80% of our distribution happens via agent partners. Yeah, that's it.
Distribution mix.
Hello.
It is going to be technology guided. Our distribution mix going forward is going to be more technology aided. We are going to bet more on digital means of procuring business. So towards that direction, we have invested a lot of time and money and manpower, and we are very confident that we are going to have a huge business either directly or through our web sales and through our digital sales.
But sir, are we looking at any sort of breakup that you can give us in terms of numbers and channels?
See, the distribution strategy for the next 5 years, if you may ask, which you are asking, is there are areas of improvement which we have identified, which we believe will be our focus area. Which one is our partnerships and bank assurance business. Today, that contributes to around 10% of our new business, which we believe should go up to at least 20-25% going forward. The opportunity is there. Now the regulations are also enabling to that. The second piece is the digital business. Our digital business is also growing rapidly. It's also contributing upwards of 10% of our new business as we speak. So, we would like to take that also to the levels of 20-25% in the next 5 years' time. So yes, the business mix would largely migrate towards a more wholesome distribution strategy, where agency continues to be the mainstay of the business, but the other channels like banker, partnerships, digital, and other ecosystem players on the digital side will contribute more.
Okay. And sir, the claims ratio guidance number, I missed out on the opening remarks.
So claims ratio guidance, there was a comment made by Dr. Prakash that we reiterate our claims ratio guidance, since we have completed 10 months, and we maintain the guidance of 63 to 65%.
Okay, sir. That helps. Thank you so much.
Thank you. A reminder to participants, please press star and 1 to ask a question. The next question is from the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Hi. Thanks for taking my questions. I had 2 of them. So my first question was on, I just wanted to understand how the structure of the combined ratio works. So, if we are at, say, 63 to 65% target claim ratio and our combined ratio is 93 to 95%, it basically means, OPEX ratio is about 30%, which is roughly where we are today. But given we have, say, about 7-8% of our premium as fixed costs, shouldn't we see operating leverage on these costs over time? And so over time, can the combined ratio, which is 93 to 95% today, actually go lower as we benefit from this? Or is there a possibility that the loss ratios could also go up over time as we, in this business, as the customer vintage increases, the loss ratios tend to increase as well. So how do we look at the combined ratio and the loss ratios evolving over time for our business?
What happens is over a period of time, there will be efficiencies that will come in the expense ratio, but we will continue to invest in our business, in terms of the digital, in terms of technology, in terms of refurbishment of our infrastructure. So that will ensure that while we keep on reducing the cost and take benefits of the scale, it should remain in that range or slightly lower than that. Same thing for the loss ratio as well. As we take the price increase, the loss ratio will decrease. Then across other products, there will be inflation which will come through. So that is where we are saying, we will continue to operate in 63 to 65 range. Whenever we take a price increase, which is coming through in the next 12 to 18 months in terms of the earned premium, the loss ratio will tend to be at the lower end. It will increase and remain in that range over a medium to long period of time.
Got it. And my next question was more on, someone had asked about whether we would consider doing life insurance if we're allowed to do it. And I know you had mentioned that, this is something you are evaluating. But my question was more on how do you guys think about your right to win in that category? Because, at this point in time, there are multiple players who are there already. And, from, our strength point of view, whether it's our distribution channel, our brand, and also our ability to, price for risk here, because the risk is also very different. So how do you think, Star would be positioned if, you actually decide to, get into, term protection manufacturing?
Our brand image, our agency strength, and our distribution reach and scale across the country, our presence across the country. So we have a lot of things to our advantage, and this can complement to our existing portfolio. We are very confident, and we are in the habit of creating benchmark in the industry. There are a lot of people doing health. We started, and we know we are dominant player today. So meaning that, we are very confident about what we are doing with our scale, presence and reach. Any of these things could only complement to our existing portfolios, and we are bound to grow more and more.
Okay. And as a approach, do you all, typically what we notice is in any industry, the top players tend to, kind of dominate market share in the profit pool over time. So when you all think about entering into any new category, do you all, will you all only do it if you all see a roadmap to you all becoming a leader, or will you all also enter into categories that you think, it could be synergistic and the customer might, appreciate you all having, those products as well? Like, how do you guys think about it?
See, the strategy will always be to build a sustainable model which is also profitable. Okay, so we are not going to be in business for the sake of being in business, but the fact of the matter is, there are opportunities which is coming up, and we are evaluating as we speak. So other lines of business being one, but there is also opportunities in various adjacencies to our own core business of health in terms of how we can provide more value-added services. Is there any measures to monetize those things? We are working on all of these areas, and we hope that given, as Dr. Prakash mentioned, the size and scale and the brand and the trust that we have earned in the market over the last 15 years, I think there are opportunities for us to leverage all of this and grow the business. And you will understand also that in the insurance business, the health is the toughest business to be in. Okay, and we have overcome that milestone to some extent as we speak. And for us to get into other lines of business is relatively simpler as compared to somebody else trying to get into health and establish a presence there. So we'll see how it pans out, but this is what we are thinking about right now.
Got it. Thank you for answering my question.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Pankaj Murarka from Renaissance. Please go ahead.
Yeah, there have been a lot of these questions on price hike. I just want to understand, what will this price hike do to your market share? Meaning, are we saying that the market share will remain around where it is even after the price hike, or does it change things?
Well, I think I should be. I should clarify the logic out here. So the price hike is not the first time we are doing. We are 16 years in the market, and for the particular product FHO, we are doing the second price hike in this 6 years. And this will take at least 2 years for us to become fully alive and rolling. For us to see the benefits. To be very fully active, it may take another close to 18 to 24 months. And the price hike also is at a range of 8 to 10 at the lowest, to 36 to 38 at the highest. It depends on the geography, it depends on the individual and his age. There are so many factors. So I just want to clear this, and I hope every one of us can understand. Price hike is something which we regularly do. We are in the habit of studying the loss of a product on a product-to-product basis, and whenever there is a need, we pitch in and we do a price hike. We always work towards, as my colleague was talking about, sustainable profit and growth. If we have to work towards that, we work on every unit, every fundamental unit that can help us to achieve that sustainable profit. We work on it, and one of them is price hike for a product.
I get your point, sir, that your distribution is heterogeneous and your customer set is also subset is heterogeneous and it's not homogeneous. My question still remains that once this price hike is absorbed over the next 18 months, as you said, where do you see your market share? One. And second, now related question is, are we, since you've been around in business for long but publicly listed for a brief while, are we saying that this industry has pricing power where you can raise prices at least linked to inflation, or what's the long-term price inflation in pricing for a like-to-like product that this industry sees over medium term to long term? If you can share some insights on that, that will be helpful.
Yeah, I don't see any correlation between market share and price increase. Irrespective of this price increase, we are bound to hold the largest market share. And as Mr. Anand Roy was pointing out in his deliberation that, every year we are only increasing our market share. So irrespective of this, we are confident of, increasing our market share because we have multiple strategies to infiltrate and enhance our penetration.
Okay. Can I ask one related question? On a like-to-like basis, where do you stand in your assessment in terms of industry pricing? Are you, for a comparable product, are you the highest pricing or somewhere in the middle, or where do you stand in the industry in terms of pricing?
We are very careful in moderating this, and we may be at the average, or an inch less than the average also, because we don't do premium loading on the product. We have one price for the product, and there is easy guidance to the customer who approaches us. And I cannot say that we are the costliest in the market. At the same time, I cannot say that our USP is the cheapest price. So we are somewhere in between.
And that is the position you want to maintain?
Certainly.
Because when you're saying that market share is immune to pricing, there is some disconnect which I'm not able to appreciate. That you're saying that market share will not be influenced by pricing. So I understand what you're trying to say is influenced by other factors, including servicing, turnaround times, and other things. But to say that it's completely immune to pricing, meaning, is that what you would say?
No, servicing the policy, achieving the customer satisfaction, maintaining a good relationship with the hospitals, all these things are going to enhance our penetration. Star Health Insurance as a brand is dominant today because of our efficiency in servicing. It is the servicing of our customers which has given us this brand image. So we continue to do that. And particularly when it comes to a price revision, we take into consideration our customers' needs and requirements. And accordingly, we do all these things. Because we have grown, we want to take our customers along with us. It is not that. So we are very cognizant of retaining our renewal retention, and at the same time growing on fresh business subsequent to this revision that we have done in one of our products. And it helps, as you all know, it is not a commodity product. It is an engagement product. The way we have been constantly engaging with the customer has brought us to this stage.
Thank you. Next question is on the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Sorry to harp on this price hike again, but just thinking aloud, is it fair to or could you just highlight whether if the cohorts that we are operating in today in that product that remains the same next year, and the price hike is implemented, your total premium of family health Optima will grow at 25%, or based on cohorts the growth could be different?
In the recent past, we have also introduced other products like Health Assure and Women Care, and those products are also doing very well in the market. So, every year with the introduction of a new product, particularly a product with a lot of innovative and new features. For example, we have introduced a product where we are giving day one cover to the newborn.
Dr. Prakash,
company to give a cover for a baby born from day one. So every product has got some attractive new features, and when there are new products introduced, naturally there may be some fresh customers attracted to that product.
question is very specific to Family Health Optima cohorts. So if you have the current cohorts, whatever who have Family Health Optima products, and you implement the price hike, would you see a 25% growth in that Family Health Optima premium for next year?
So see, technically what you're asking is right. If the same cohorts remain, there should be a 25% price hike across the board. It will take, as my colleagues have mentioned, around 18 months to 24 months for the whole thing to play out. But we have seen in the past that in case there are certain cohorts of customers who may want to shift to probably some other 1 or 2%, there are dropouts from this product line. So exactly, I cannot commit that there will be 25% price hike in the overall portfolio, but around that range is what I think we should be able to achieve.
Just extending that point, so is it fair to assume that when you mentioned that the price hike ranges from anywhere between 13% to 36%, that kind of 36-40% kind of range, is it fair to assume that the higher end is towards more cohorts where you either way kind of want to exit and reduce that share, say possibly a senior citizen or a higher age bracket, not the senior citizen, the higher age bracket, or geographies where you have a relatively higher loss ratio experience?
So, to a large extent, your question is correct. Unfortunately, the regulations do not allow us to price based on age-wise cohorts, reprice rather. So we have done some geographical realignment of our the cities that we operate in, and some of the higher loss-making, higher ICR cities have been brought into the higher price bucket, if you may say so. But that's the alignment which we have done.
Got that. And last bit, in case whenever the risk-based solvency is implemented, what kind of solvency we would we gain from it?
See, what happens is when it comes to risk-based solvency, all the factors are considered in terms of the investment portfolio, the reinsurance receivables, which we don't have any because we don't have reinsurance, the claim outstanding, the business model. We had done some rough workings, basis of Singapore risk-based solvency, and we see that for us it is more than 2 times the required level. And what happens is, in today's scenario, as you keep on growing, because it is premium factor based, your solvency drops by a certain level. And we have indicated that, it can drop by 8 to 10 basis points every year. But when it comes to risk-based solvency, since it's balance sheet method, there is no pressure on solvency as you keep on growing the business. So it's more sustainable in terms of the capital requirement.
Great. Thank you so much.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Nilesh Kambli for closing comments. Thank you, and over to you.
Thank you everyone for joining the call. As spoken on the call, we are focused on sustainable, profitable growth, and we are taking all the decisions to achieve that goal. And thanks once again for joining the call. Thank you very much.
Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, on behalf of Star Health and Allied Insurance Company Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.